Every year, South Africans lose thousands of rands, not because they earn too little, but because they just don't tax plan. Now, let me show you with a real life example, which is so common. Imagine you earn 750,000 rand per year. That's about 62,500 rand a month, right? Before deductions. No other benefits, just pure salary. Your employer, they already sort out your PAYE, so your salary tax is completely covered. But now, let's say you also have 1 million rand that's in an interest-bearing account, earning roughly 7.5% interest per year. That's 75,000 rand in interest. SARS only gives you a small exemption, which is 23,800 rand. So about 51,200 is completely taxable and it gets added on top of your salary. At your level of income, you fall into the 39% tax bracket. That means SARS takes roughly 19,000 rand, let's call it 20,000 rand, in extra tax just from the interest income. Now here's where tax planning actually changes the story. SARS allows you to contribute up to 27.5% of your taxable income into a retirement annuity. Obviously that's capped at 350,000 rand per year. So if you contribute 50,000 rand into an RA, instead of losing 20,000 rand to SARS, you reduce your taxable income, save that tax, and you let your 50,000 rand compound for you until retirement. Now, I know some of you are thinking, so I must spend 50,000 rand just to save 20,000 rand. But here's the difference. When you pay SARS, the money is gone forever. When you put it into your RA, it's still your money, invested, protected, and growing. So ask yourself, would you rather hand 20,000 rand to SARS every year or redirect it into an asset that builds your wealth? Now that's the power of tax planning. And if you need a chartered accountant that's in your corner and you understand how tax planning works and works with them, my information is in my bio.